Hi, and welcome today to our recording session. And I am excited to introduce my friend and professional associate, Rich Cromwick. In much of what we help people with building and saving towards retirement, and in the process, saving taxes. So, as part of working with business owners that want to set up retirement plans, I I involve Rich Cromwick, who's an administrator. Rich, can you tell us a little bit about what you do and the day to day of being an
Yes.
administrator of retirement plans?
Yes, I graduated from University of Arizona in Tucson in 1989, and I started in the pension business since that date. So I've been involved for 36 years now doing administration for high-end earners, people who need deductions. So I basically do the administration. We do the compliance testing. We do communication. We do training. And we basically, our main job is to just keep the client totally in compliance. So we deal with everything.
Thank you. I know there's a lot of different types of retirement plans, and one of the things that you help me do on the front end is design a plan that works for this business owner. What's that look like?
That's my favorite part of the job.
All
My
right.
favorite part, and you know that you'll send me a proposal. And what we do is we send out proper forms. So we send out an employer data form, which gives me the information of do they have other companies, the type of business, and then we get a census request that gives the employees ages and compensation history. So by that, and then we will look at a potential design. And so initially, we'll look at a combo, which we'll explain later, a cash balanced 401k combo, which we love. And this allows great flexibility for the owner to put away significant deductions. And we can discuss that later, but that's what we do. So my favorite part is designing the plan and coming up with the best results for the owner. Now, keep this in mind. A lot of firms will just do 401k plans. A 401k plan is not always a great plan for an owner who's making good money. So it's a cookie cutter plan. My objective is what can I do to accomplish a benefit for the owner above and beyond a simple 401k plan. And I'm not against 401k plans, Adam,
Oh, of
but they
course.
don't work. If you have an owner making $400,000 or $500,000 a year in net retained earnings, then obviously that doesn't cut it.
Sure. Someone who's making $1 million a year, for instance, that wants to defer more income and save on more taxes and build the nest egg faster, there's better ways than the 401k.
Yes.
So, how did you end up specializing in cash balance plans, and what keeps you in that niche?
I was lucky. No, I was basically, I've been involved in the business, like I said, for a long time. And it's basically working for a firm about 30 years ago, actually 25 years ago, was a company called Actuaries Unlimited. And that's where I got my taste of defined benefit and combo plans. And then since I've worked for now Pace TPA, the company I'm now with for almost 20 years, and that's when I really got involved with the cash balance concept. And I actually have done training sessions for CPA firms where you go in and you do a presentation, you bring a lunch. So the more I've been involved in this business, the more I've been impressed with the cash balance 401k profit sharing combo, which we can discuss
Sure.
with that in a moment. But cash balance plans are really effective for
Sure.
the right scenario. But it's just a case where I love good design. Now, what I mean by that, Adam, is my plans, we have to test them. It's not a cookie cutter plan where it's a
Sure.
basic formula. My objective is to give as much benefit to the owner with as limited liability to the employees. So our designs, and I have a couple examples with me,
Yeah.
we're giving a significant dollar amount to the owners, and we're giving what we need to give. It's proper discrimination by the IRS standards. So I like the way I look at it is we're beating the IRS, playing by their rules.
Beautiful. So I've enjoyed doing these and getting these done, and you've helped land this plane, so to speak, more than once. But let's take a step back for a moment. In plain English, what is a cash balance plan, and why do so many business owners not even know they exist?
That's a great question. And the thing is that most CPAs aren't aware of it either because it's not part of their training.
Yeah.
So it's a case where it's a special field, and so a lot of CPAs are not familiar with these type of plans, unfortunately, and that's why I love to do trainings. But a cash balance plan is a hybrid of a defined benefit plan. Now, a defined benefit plan is fixed, determined benefits at retirement age. The key to, though, I'm going to just read off this. A cash balance plan is a type of DB plan that allows large tax-deductible retirement contributions that are tax-deferred and protected from creditors, assuming you have employees. That's a big plus. These plans are ideal for business owners and self-employed individuals who want to ramp up their retirement savings while reducing their tax burdens. And again, these plans work well for anybody 40 or over, works great, but even in the 30s, high 30s, depending upon the scenario.
If there's a high income business owner and they just have a 401k, what are they leaving on the table, Rich?
A large taxable potential. They're leaving away. They're going to pay a lot more taxes. The thing about the cash balance plan, I'll give another example. It's like a profit sharing plan on steroids. A profit sharing plan, you have a beginning balance, you have earnings, and then you have a potential contribution, and you have an ending balance. Well, a cash balance plan, you have a hypothetical account balance, you have a formula, a contribution that could be a percentage of pay or a fixed dollar amount, and you have an assumed interest rate assumption. So your statements look like a profit sharing plan. Very easy to read, very easy to understand, as opposed to a DB plan, which is all based on annuities, very complicating and very difficult.
Great. So tell us a little bit about the actuary, like the limits.
The limits. And I have some examples here. If we can cover that now, but I have examples. For example, let's assume someone is 35 years old, and I'll give some examples, and a person's taking a max income.
Mm-hmm.
And just for the purpose of the max results, they take a $360,000 salary. These are 2026 numbers. They take a $72,000 401k profit sharing plan. That's the max. But with a cash balance plan, they can do $97,000 in the deduction.
Fantastic.
So basically, that's pretty significant. Now let's give a better example. You're 50 years old. You have a $360,000 compensation. The 401k, the max is $80,000. But in the cash balance plan, you can put $204,000 away. That's per year.
Yeah, when you add those together, that's pretty significant.
And if you take someone in their 60s, you're looking at $336,000 for the cash balance alone.
Yeah.
And you can get and even more. So you have the ability to put $300,000, $400,000, $500,000 into a plan. And you have the ability, we'll discuss flexibility a little later, but it allows a person that has a windfall to take advantage of the tax savings.
Great. So, Rich, at what income level for a business owner does this start to make sense?
It's really about retained earnings. If they had retained earnings, obviously they need to look at this now. Obviously, if they have a low W-2 or Schedule C, that's going to impact the cost to the employees. So here's an example where if you have a higher income, the results work more favorably where you can give less to the employees. So I can design a plan, say an owner making $100,000 W-2, and it's going to be more costly if he has a bunch of employees as opposed to if he makes $200,000 to get the same results.
Interesting.
So the W-2 or the Schedule C or the partnership income that will help in terms of discrimination to the employees. Very important. So I like to look at that. Now, obviously, we're looking at a company with employees. If we're looking just a standalone plan with just the owner only or owner and his spouse, again, an owner and his spouse is an owner only plan. So you can now take advantage of both spouses and really boost the deductions, which is not a bad idea sometimes.
Yeah. So
you might have an example that we did recently.
Yeah, several actually.
That's my point. So you could actually bring one of those examples where we actually got some great results.
Yeah. I mean, a handful of these that we just did in the last year where there's been a business owner that's been able to do both the 401k, the profit sharing contributions, and oftentimes include a spouse, so where there's a double effect, and then on top of that, get $250,000 to $450,000 into the cash balance plan and get the deduction. It's huge.
Yeah, basically the limit. The limit at age 62 right now with a current comps is $3.7 million. Now, let me clarify that. If a person is 52 or younger, and that means they have 10 years of participation, because if you start at 52 to 62 would be 10 years of participation, the max benefit. So therefore, a person who has the right comp history can accumulate up to 3.7. Now, let me clarify that. Here's the key. Once you establish 3 years consecutive high income, that's it. You don't need to keep on taking that income. So if I want to get $3.7 million into a plan, and I'm 50 years old, and I take $290,000 for the next 3 years, then I have the ability to accumulate the 3.7, even if I reduce my comp by half.
So that's the sweet spot for the max, is to have a 3-year salary W-2 or income. Yeah.
That's a critical point, Adam. It's a critical point. You need 3 consecutive years, and you don't need to continue to repeat it. And this is what makes it very attractive. I'll give an example. Let's assume we take $200,000 as a simple example for 3 years in a row. Are we doing a profit sharing plan? 25% of pay, $50,000. So that person has to continue to take $200,000 every year to get $50,000 deduction. Now, if you're taking $200,000 and you're doing a DB plan and you're in your 50s, I can get you $200,000 a year deduction. If you reduce your salary down to $100,000 or less, you still get the deduction.
Sure.
You still get the same deduction, and you're reducing your W-2.
That is amazing.
Critical.
Yeah. And that's a flexibility you can't get from defined contribution plans. So
no, defined contribution plans, you're limited. It's 25% of pay, and there's really not much flexibility.
So, Rich, what do you think is the biggest missed opportunity here?
You and I have it all the time.
Yeah.
We have clients, I need a deduction. They needed a deduction 5 years ago. They're finally waking up and saying, how do I deal with my excess retained earnings and avoid these ridiculous taxes? So the point is that a lot of people are uneducated, and that's where you and I and we need to train the CPAs to look for opportunities, because they exist. People are not taking advantage of these type of plans, Adam, and unfortunately, they're missing out on some really significant deductions. And so that's where we need to just be on the ball and always look for those opportunities. And that's why I'd like to go and start visiting some of these CPAs and say, hey, this is what we can do. And show people, hey, and put together a brochure that gives a little information, very simple. Hey, you can get these deductions like the one I have here. Hey, this is a max deduction at this age. That's very attractive and very easy to understand.
So when we talked about our target, who's the right fit for these, it's typically higher income or higher retained earnings. And what about age?
The older you are, the more effective these plans are. So these plans are designed because you have a retirement age. So if you're 55 years old and you're retiring at 65, you only have 10 years. So you have to put away more money because there's a goal. Think of it. There's a 3.7 million goal. So if I'm 55 and I have the right comp history and I want to accumulate, I have 10 years to accumulate 3.7 million. If I'm 40 years old and have the same scenario, I have now 22, depending upon the retirement age, to accumulate. So therefore, with interest each year, and it's going to reduce the deductions. So the ideal scenario is someone that's 52 years old, because 62 is the ideal retirement age. Ideal. Yeah. So if you're 52 and you want to retire at 62, you can put 3.7 plus million right now with the current DOL limits. That could go up.
And it has been, right?
Every year, pretty much. Yeah. It was only without exception, almost every single year. I think there's like a couple of times it didn't.
Okay. So, Rich, how are these different, like, say, than the traditional pension plans? The the cash balance plans versus the traditional pension plans that have been out there for ages?
They both have the same limits. The difference is the ease of understanding the cash balance and the flexibility, because a defined benefit plan, it's more complicating. The formula is looking at factors that you can't control. In a cash balance plan, I can design it where it's a percentage of pay. So I already have a flexibility. So you take a person's pay, you multiply it by that percentage, and then you know in advance, Adam, what your contribution liability will be. With a DB plan, you already have comp history, and it does make a difference what you take for comp the current year sometimes, and you still have a contribution liability.
Sure.
For the cash balance plan, you're having a lousy year. You say, hey, cut back your W-2 this year, and that's going to reduce your contribution requirements. So that's critical. You can actually control what you have to fund. A defined benefit plan, you're stuck. You already have the contribution, the comp history. So regardless of what you take for comp, it's not going to impact the results. So you need now to deal with that current year, and then you want to amend the plan next year, which you can do. You can amend a formula every 3 to 5 years. It's okay to amend the plan formula, even with a cash balance plan.
So
does that make sense in terms of that's flexibility?
What about for the business owner to dial up or down contributions based on how their income is?
So when you design the plan, the first thing you want to do, Adam, is you want to do a 2-year window. So you know the potential liabilities for 2 years in a row. And then in the third year, you already know what's going on, so you can make changes if you need to. So the whole idea is being proactive.
Sure.
That's where okay, let's design a plan. Let's assume that the year you have now is going to be similar to the next year, and we design it accordingly. Now, here's what I do. Let's assume the client had a great year. Okay, we had some. I designed the formula in such a way for the cash balance plan where I give a prior credit. So I can give a beginning account balance and put that in a formula, and then I have a percentage of pay for the current comp. But next year, you already accumulated that beginning account balance, so you don't add it again. So you basically, right there, it's going to reduce your contribution requirement. You're basically taking a hypothetical beginning account balance based on prior comp history, and now in year 27 or 28, whatever, it's going to be reduced because of the way I designed the plan. So I'm actually pre-funding the first year's benefit, and that gives me a cushion. So the next year, I already have some flexibility.
So we're in 2026 right now, and one of the interesting things is when you put the money in, right? So talk about the flexibility. Like when does the flexibility for 2026 go away?
Okay. First of all, because of the Secure Act 2.0, you can still do qualified retirement plans for 25. So the first thing we need to realize, it's not too late. So if you have clients that still need a tax reducing type of opportunity, it still exists. So when you design the plan for 26, basically we want to get an idea. All right, if I know a client is going to have a bad year, then the only way to reduce that formula is to do the amendment early in the year, Adam. So for example, let's assume I have a client that's not having a good year right now in 26, and the plan's already in place. Okay.
Mm-hmm.
Here's the feature. You can amend the plan formula right now. They don't have 1,000 hours, and this is the time to do it. So we both have a client that's having struggles. Hey, let's amend the plan formula for 2026 because you haven't accumulated 1,000 hours. Now, once you accumulate 1,000 hours, you can't amend the plan formula. Now you have to look at what they make for compensation, and and you can look at that, but you really have no choice but to go with it. But here's the good news. Gets a little complicating, but let's assume we have a tough year, 26, and the person has a $100,000 contribution liability, okay? And they can only put in $40,000 for 26 because they don't need the deduction. Okay, they put the $40,000 in. Remember now, it's a $100,000 liability. They put the $40,000 in April of 27. They do the taxes, okay?
Yep.
As long as they put that $60,000 in by September 15th, they've covered their requirements. That's a deduction for 27. You've probably never heard of this. So you're getting the deduction, the $40,000 for 26, and the other amount you're putting in on time to meet the requirements for the plan I set up, and that $60,000 will be a deduction for 2027. And then of course by that point in time we've already amended the plan formula for 27. But that's an option, which I'm dealing right now with a couple of clients where, Rich, I can't make the deduction. Okay, put in what you can, and the person did. You put in 20 grand. I said, you got to put another $50,000 in before September, and and the report's going to show $70,000 on my report, but the tax return is going to show $20,000 one year and $50,000 another year. Now, that's really getting complicating, but It's called a double dip. You're using that money for 2 different years for the tax return, but I'm still covering myself for my clients. The report that I sent to the IRS, which is correct now. Interesting.
Okay. So
you're probably not familiar with that.
I haven't used that, but one of the things that's happened with clients is sometimes they have a tough year and and they will say freeze, or
It's an amendment. As
Yeah.
long as you freeze the plan before 1,000 hours, Adam, it's legitimate. You're basically
Okay.
freezing a formula, and I do that a lot.
And it's critical it happens this year, not after the fact.
It has to happen before the employees have 1,000 hours.
Okay.
So right now we're talking it's April 25th. So we could probably still amend the plan right now all the way into May, maybe even early June, because by that time most people don't have 1,000 hours worked.
Yeah.
So that's now where the time where if we have clients that are struggling, we need to say, hey, listen, let's freeze the plan right now.
So there's these terms, Rich: pay credit, interest credit. How much does that matter in cash balance plans? And
It's all based on a plan formula in the plan
Okay.
document. So the pay formula is an example of, say, 100% of pay. So a
Mhm.
person makes $80,000 W-2 and he has the right requirements. His contribution credit or pay credit will be $80,000 on the statement. And the earnings will usually be 5%. We assume a hypothetical interest rate of 5% on the plan document. So the statement is going to show a 5% interest rate. It's going to show a pay credit of whatever, and then it's going to have an ending balance. Very simple. Now, the value in the account, the statement might be more or might be less. It does make a difference. We're basically designing the plan based upon the plan formula, and that's what the employee or the owner gets as a statement. But the earnings or the amount in the plan could be either higher or lower. And that's why each year we look at the statement you give to us, and then we do the calculations, and we come up with a new pay credit with a new interest, the same interest rate of 5%, and we have a new statement at the end of the year, and that's what we're funding for. And then the calculations will determine the minimum and the maximum to accumulate that. So you have to realize we look at interest assumptions in the calculations because we have a lot of years to accumulate. So even if a person has a lousy year with the investment side, you're accumulating the over so many years, so you don't have this ridiculous large requirement because it's not looking at that. It's looking at how much I have so many years to fund this plan, and so therefore it gives me some flexibility.
Great.
Hopefully that makes sense.
So in my interpretation, Rich, and tell me if I'm wrong, but if my W-2 is my compensation is $100,000, then the pay credit is going to be based on that.
In most cases. Now,
Okay.
you can design a plan where it can be a fixed amount. So, for example, I could say instead of a percentage of pay, I could say each year the owner accumulates $125,000 pay credit, and that's the amount. So beginning balance would be whatever, and then the pay credit would be $125,000 each year. So you can set up the plan with a fixed amount or a percentage of pay or a combination. I can design the plan like 100% of pay, maximum $200,000. So I can limit the pay credit. So I can do a percentage of pay with a limit.
Okay.
Or I can do it with a minimum. I can do 50% of pay, minimum $40,000 pay credit. Both ways.
Beautiful. I love the flexibility of these over time. I find
they're
more
a little more
levers.
flexible.
Yeah. And the interest, I mean, it really comes down to critical craftsmanship in the beginning of the plan and then possibly through amendments. Is that?
Yes. Yeah, exactly. You need to, when you set the plan up, that's the time to really look at those first couple of years. Now, you and I have already set up a bunch of plans this year, and most of them, we're taking advantage of that. The numbers, what I do is the first year, since I know what they want to put in, I design the formula so that we hit right at the maximum level. We want to hit that number. So that way we already create a cushion for next year.
Yeah.
So when I designed the plan in 25 for the clients you and I did, I want to hit the range, to get a range in a cash balance plan or a defined benefit plan. They'll be based upon the actuarial calculations. There'll be a minimum contribution amount. There'll be a maximum. We have to fund in between that. That's required. And so I like to go to the higher end because right off the get-go, I'm creating a cushion for next year.
And it seems most of the ones I've seen for business owners that are highly compensated, that are in their 40s or 50s, that set up a cash balance plan, they'll get a range of something in the neighborhood of $100,000 to $400,000.
Significant.
Big range.
First year is not much of a range because of the way the cash balance operate. But the next year, that range keeps on increasing. It's kind of neat. So the first year, you have a little more less flexibility, but we're designing the plan based upon what he's trying to accomplish. So
Sure.
we know what the number is. So then we just work our way into that formula. And the year after, it gets more, that range will increase because of the interest that you make and plus the fact that you have more years of service.
One of the things that we know is that if they fund at the high end of the range, what is going to happen over time?
Eventually, it's going to get to a point where there won't be there will be no contribution requirement, and now you have the flexibility not even to fund. And I
Sure.
prefer that sometimes. And then we need to look at a case like that where, okay, he's fully funded, we have an excess. Do we bring the wife in or spouse in, or do we look at some other options? So basically, I'd rather have a plan fully funded with a little cushion where there is no contribution requirement, and we can look at other factors. And do we consider adding another type of plan, or do we look at some other dynamics?
Rich, there's a common topic that seems to come up almost every year, and it's the topic of control groups and affiliated service groups. Can you talk about that for a moment?
I'll talk about control groups, but I'm not going to make a case on affiliated service groups because they're beyond my pay grade.
Okay.
But they basically have to do with, let's talk about a control group. A control group is, say, for example, an owner has more than one company. Very simple example. If an owner only has more than 80% of other entities, that's a control group. So if I have an owner that has 100% ownership in his business, he has another entity he owns over 80%, that's a control group. So that means that person's both plans have to be covered when we design it. So good example is, let's assume his 100% ownership, it's only him. But his other company, he has 10 employees. You have to include those employees. That's a control group. That's a basic example, and you have to include both groups.
And if it's only 40% ownership?
If it's only 40% ownership and the revenue is different revenue, because this is now where you get into the affiliated service group issues.
Mm-hmm.
Where's the revenue coming from? If the revenue is coming from that 40% business, Adam, that's an affiliated service group.
Yeah.
So affiliated service group doesn't look at ownership. It looks at where is the money coming from. And if it's like more than 10%, then those two entities are affiliated because the revenue structure is coming, the resources from both companies. So it gets more complicating. So that's where we have the potential for an affiliated service group. I highly recommend get a attorney, get a risk attorney to look at it because we don't want to take that chance.
Sure. So walk me through the tax math, say high income, high earning doctor, dentist, attorney, and they want to retire in 10 years. What is this what does the math look like?
Oh, well, basically the first thing we need to look at is history. So if they have comp history, that allows me to have more flexibility. So you have two types of examples, Adam. Number one, you have an owner, like a doctor, an attorney, that has 3 or 4 years of prior history. Now, that's going to give me a lot of flexibility because I already have a comp history. So that gives me much more flexibility in designing the plan. What I look at then is his age, how close he is to retirement, what type of comp has he taken, because the maximum, again, is based upon a high 3-year average of $290,000. So we have to look at that stuff. But the best thing about an owner that has years of comp before the business, before we start the plan, is that even if he has low comp, I can take that formula and still get a significant deduction, assuming he's going to take more comp later on. Now, if the person is a brand new startup business, then you're more limited in terms of the benefit. But again, we're talking about what the age is. In this case, is in their 40s or high 40s, early 50s, then if they have the right comp history, it works great. I like, if we can get them to take the $290,000, great, but you don't need to. Let's just assume this person is 56 years old and he has only $150,000 for the last few years. I still can get him a significant benefit because of the fact that history, I can accumulate all that because the IRS allows me to take advantage of that. So I get significant deductions over the next 4 or 5 years, even in that scenario. So it's a case by case. It's a case by case.
So when contributions are made versus when deductions are taken, can you go through the timing of that?
Well, when you mean contributions, are you talking about what the client puts in?
Yeah.
Is that the same thing as a deduction?
Correct.
So I'm confused.
So 2026 is the plan year. They may make their contribution next year. But as far as when they take that deduction, is it based on the plan year or the year that they made the contribution?
It's based upon the tax year. So
Okay.
basically what's going on here is this. You have a client right now making deductions in 26. Those deductions in 26 are for 25. And so their taxes, they're extending the taxes at them. So
Okay.
you have clients I have a bunch of clients that are waiting to fund, and that contribution is a tax deduction for 26. The
Perfect.
CPA will do the tax return once the contribution's made, and in most cases, you're looking at a 25 deduction. Very rarely is it the other way around.
Got it. And then as far as the pass-through entities and with cash balance plans, how does that interact?
What do you mean? What do you mean
Like
pass through?
you have S corps, right? A lot of professionals have S corporations. Does that add any complexity?
No, because what I do. We have an S corporation.
Mm-hmm.
And then he also has another entity with the employees. We do a joinder agreement. A joinder agreement we set the plan up under the company, and the S corporation or his other adopts the plan. So if you have an entity that does have control group
Mm-hmm.
or affiliated service group, that's fine. We know it. We don't mind. We have all those entities adopt the plan. And so when we do that, when a person makes his deductions, he can take the deductions from any one of those entities. So I have no problem with that. I have an attorney firm right now that she has like 3 different entities, and all 3 entities adopt a plan, so she can fund any one of those plans
So as
from
far as
any of those entities.
Rich, as far as the different ownership entities like C, S corp, partnerships, sole proprietor, does it matter?
No, here's the key. As long as the income is subject to Social Security. Let me clarify this. You have to have income that's subject to Social Security. So W-2 is income subject to Social Security. A Schedule C has self-employment tax. You have to be careful where a client will come to you, oh, Rich, I need a plan. And over the last 5 years, all they've taken was a draw. You can't do a plan. We have to be very careful because they have no income subject to Social Security. So this is very important for anybody listening. You have to have income subject to some type of Social Security to make this work. Otherwise, you're going to have a problem.
Yeah, or FICA tax, right?
Yes.
Yep.
Exactly.
So one of the things that's come up multiple times over the years is business owners will ask, hey, if I'm putting in for employees, how do we model that I'm going to end up ahead on an after-tax basis?
Well, the question comes down to is this. What are you looking at? All right. So if you have a company, let's assume you have 10 employees, and I have a couple examples here. This is a plan I did. It's a doctor firm, and there's about a half dozen doctors, and there's another 7 or 8 employees. And my design was, you're going to get a kick out of this. The contribution requirement's $1.5 million, but I'm getting 94.7% to the owners.
Mm.
Okay. So the question comes down to, you got 5 doctors. They can divvy up the difference of that cost to the employees. So what percentage are you okay with? And we have to look at other variables. Employee retention. Do you mind giving money to some of your employees if it's going to help the company's cause? So the question is, how much are you willing to give away to the employees to make it work? Now, when I designed the plan, my goal is to get as much to the owners as possible. That's an example. Here's an example here where I gave more to the employees, but look what I got the owners. I got $600,000 to the 2 owners, and they only took $150,000 salary each. $600,000 contribution. They only took $150,000 W-2 each. That's a 200% pay increase. I had to give away $43,000 to the employees. There's 6 employees. That's a win-win.
That's a lot of money going into the retirement benefits of the doctors. Still something for the employees, and it's rather generous. But
It is.
But the math works out pretty compelling.
Yeah, if they took more comp, that number would be lower too, by the way. But so that's an example. Here's an example here where I have just a small firm. I have a $207,000 deduction, to the owner, and we're giving away 4561. We're giving away $5,000. So he's getting 97.85% of the pie. He's giving away 2.15%. Now I've had examples where I give away 80% to the owner. But again, I have clients that want to give money to the employees. They don't mind giving a benefit.
Sure.
So we have this idea that all owners want to take everything. No, there's some owners that say, what can I do? And I don't mind giving to the employees. Makes my life easy.
Well, one of the things I like to point out is that depending on what state you live in, because that can play a part too, but high income earners are often in the between 30 to 50% tax bracket.
Yep.
When you factor state and federal. So that being said, any of the money that's going and getting diverted into these retirement plans, you're saving 30 to 50% in taxes currently, right?
So here's an example where you and I need to keep the CPA informed. So if you and I have a proposal we're working on, we really want to involve the CPA because he knows the person better than we do in most cases. So this is where example, we need to create a relationship with that CPA and we're here to help. And this is an example we're working as a team. So again, I would say that when we get in these opportunities, we really want to get a hold of the CPA early on and say, hey, this is what we're trying to accomplish because he's going to help sell the plan. He or she.
Absolutely. Some of the times it's them who brings it up or it's a make or break part of the proposition.
Yeah.
And I'm glad you brought that up, Rich, because it really is a team effort.
Yeah.
And some of the best conversations that we've had has been where you, myself, the client, and their CPA are all talking together and becomes powerful.
Yeah. And again, as I said earlier, we want that to be the case. But as I said earlier, CPAs are not familiar with this. I did a seminar a while back, and I was talking about a self-employed individual, and they were under the impression you couldn't do a qualified plan. But no, that's not true. So there's an example. There's a lot of misinformation in this particular field, and that's where you and I fill that role. And we can help clients, CPAs, and there's opportunities for both of us. And I'm never worried about competition because there's so much out there. There's so much opportunities, and we are both very trained. And so I'm very comfortable working with, even with a client that has another person working on it. Matter of fact, I relish the competition because I'm convinced I can do as good a job because it gives me an opportunity to look at the designs.
That's one thing I like about you, Rich, is you like to step up to the challenge.
Yeah, that's true.
So the biggest objection with cash balance plans, once you have a ideal candidate, it oftentimes is, what happens if I can't make this contribution? There's that fear there. What do you say?
That's a good objection. And when we get into this, it's talking about the pros and the cons. Well, the con to any qualified retirement plan, and I'll answer your question, is expenses. You're going to pay administrative expenses each year. So that's something that the client needs to be aware of. Now, in terms of the question talks about the concern, you have a plan. Let's assume that you have a $50,000 contribution requirement and you just had a year you can't make it. Now, there's some options. One option is, I've done before, is a client say, Rich, I can't make the deposit. I said, well, you have enough money in the account, you can take a loan to make the deposit. It's better than not making a deposit because it's a 10% penalty. So let's assume that you can't make it. The worst case scenario is you don't make it, you pay the $5,000 penalty. Now, at this point in time, you've already amended the plan for the next year because you're trying to protect yourself, but you need to deal with that. But now my first suggestion is take a loan. It's better than paying a penalty, and then modify the plan formula and then go forward.
I'm glad you mentioned that.
But there's a 10% penalty if you don't make the contribution, and that is something that you have to deal with. And I had a client recently, I said, hey, here's an example the client overfunded. So he put in like $300,000, and the benefit was only $270,000, the deduction. So here's a $30,000 excess. He made that in 2025. It's too late. You have to now pay so he had to pay a penalty, and he said, fine, do it.
So they can, tell me if I'm wrong, but you can avoid the penalty oftentimes if you amend the plan soon enough in the year.
Of course. And that's why you want to stay on top of these plans, and you want to do projections, and you really want to keep your clients informed. The PACE TPA has changed its structure totally. We now have less clients per administrator on purpose. Our prices have gone up, but in the long run, we're trying to be more on board, more day-to-day interactions, and more talk to these clients. We're trying to keep our clients more informed of what's going on. And so therefore, and we have more time now, because if we can look at things now in advance, this is the time to do it. And say, hey, listen, I've looked at your plan. This is the situation. If you don't make this change, you have these liabilities. So we need to have those discussions, even with your clients and mine. We should talk to these clients and, hey, listen, I did some preliminaries. It could take us a couple hours to talk to each one of them.
I do think that's usually been the sticky point where maybe a retirement plan has been a challenge for someone, or they had a bad experience, is that there wasn't ongoing communication and they waited too long to let us know that they're having a bad year.
Yeah, that happens, unfortunately. And that's why we really want to be on the phone with our clients, not just sending a text or an email, because a lot of clients just don't see that. We need to be on the phone calling clients. I actually was in the office this morning early because I just look forward to going to the office, and I started making calls. I have a bunch of clients I'm still trying to get data, and I already got success. I called a couple of clients, hey, I'm missing data. And that way, see, I look at myself as, you know the TV show, The Spider-Man?
Yeah, sure.
I call myself the friendly neighborhood TPA pest.
Great.
Third-party administrator.
Rich, are there businesses or structures that just really don't work for these?
Yes. There are companies that have too many employees, number one. There's just too many employees. So really the only option is a 401k plan. They're too young. If you're in your 30s or even early 40s with a lot of employees, it's not going to work. So don't waste your time. Do a 401k plan like a safe harbor match, which I like, where you only have to contribute to those people who contribute, as opposed to a 3% where everybody gets 3% of pay. If I have to set up a 401k plan with a bunch of employees and they're younger, you and I both know most of those employees are not going to contribute. So do a safe harbor match. And that way, the only employees who get a deduction are those who contribute. But basically, you have to look at that. And I've been doing this for so long, I can look at it, the demographics, and say, this is not going to work. I'll run something for you, but it's not going to work. Sure. But again, it really depends. I've seen clients. Now, you could have clients in their 40s. If you have the right demographics, you can still do a good design. You just have to look at the employees. Let me give you an example. Here's how I know a plan's going to work. Let's assume that the owner, let's assume the owner, there's one owner, okay? And you have a bunch of employees. If half of the employees, simple test, are younger than the owner, then you have potential discrimination. The simple look. So if you say, Rich, I got a design I want to look at. I have 11 employees. Okay, look at the 10 employees that are not owners. If half of those employees are younger than the owner, then you have legitimate discrimination. Okay. It's a simple test you can do before you even send it to me.
Is discrimination a good or bad thing, Rich?
It's a good thing. Okay. We're discriminating in the sense, like I said earlier, we're discriminating to get the owner the best benefit possible, and we're limiting the employee's cost. And we're doing it with IRS guidelines. So we're not discriminating in the sense where we think of the word discriminate. We're basically using the IRS parameters to, like I said before, we're playing their game and playing by the rules.
In my own language, I see that as discrimination just means that we can skew a heavier benefit to the owner.
Yeah. That's exactly what we're doing. We're basically taking advantage of the regulations and using those regulations to our benefit. That's all.
So what is let's say you've done your cash balance plan and it's time to unwind it. What's shutting it down look like, and how bad or how long does that take?
Well, if it's not a plan covered by the PBGC, which I really want to get into today, then it takes less than a month. So let's give an example. Let's do a scenario. I got an employee, three or four employees. He calls me, sends me an email, says, Rich, I want to terminate the plan now in 26. I say, okay, great. That's the go-ahead. So the first thing I do is I do the term resolution, and that officially terminates the plan. That's a 14-day window. So if I terminate the plan now, it's 14 days from now. The plan now is officially terminated. Once I get that termination back, I can start the distribution packages now. I don't need to wait. And I can send out the package to the employees, and it's a 7-day window. You have the ability to waive the waiting time. So if I do a distribution form now, send it to the employee, he can get that benefit in 7 days. So we terminate the plan now. 2 weeks later, it's official termination date. A week after that, we could pay the employees out. Okay. So theoretically, in 3 weeks, you could pay the employees out. Now, that's the perfect world. But it shows you it can be unwound pretty quickly. If it's a pension benefit guarantee corporation, it takes 6 months.
It's a little bit stickier.
It's much more sticky.
Yeah. So you kind of touched on this earlier, Rich, but why do you think so few CPAs bring this up to their high income earning business owner clients?
Well, my experience is, and you'll agree with this, is most people do not like to do something they're not familiar with themselves. If they don't feel comfortable with what's going on and the information, then they won't do it. Now, that's a sad documentary, but that's kind of the way the world is. So that's where we come into the play and say, hey, listen, let me explain a little more details of what this plan is. And so that's where the education comes in.
Okay.
And it's that simple as that. If we can inform the CPAs a little more of, see, they're concerned about liabilities, rightfully so.
Yep.
But we need to show them, hey, listen, this plan, this client needs this works, and we give you some examples of what we can do for the next couple of years. So that's where we need to come into play.
Yeah, we can help them lower those liabilities, right?
Yeah, and then they'll thank us.
Yeah. When people out there, business owner, are looking for a retirement plan, what do they look for in an administrator?
Well, my experience is they want someone timely. I've had so much success because when you or a client sends me a potential opportunity, we respond quickly. And I've seen that to be the best selling point and with expertise. But I've noticed that a lot of people say, Rich, I had a proposal. I'm still waiting for the results. And I see that all the time. And you might too, where, I sent out this proposal to another firm. You probably haven't. And your results, you're waiting, and 2 weeks later, you haven't got an example. On our end, if you send me a proposal, Adam, or our firm, it's not just me. If you don't get a proposal, if you don't get a response back in a week, that means I either threw it out or I quit the job. No, it means that something's up. So my experience, number one, response time. Obviously, when we do the proposal, they'll see the expertise in the design. But obviously, again, my experience is, Adam, and you might feel the same way. Are we getting quick response time? And obviously, at the next step is this efficient? When you look at the plan, now we're trying to sell. That's where our knowledge is. We get on the phone. That's where we want to talk to a person. I don't want to just do an email. Hey, this is what I did. Let's talk about the design.
So if somebody already has a business has a retirement plan, and they're not happy with the administrator, there's been turnover, they're not getting responses, what are their options?
Fire that administrator and go to me.
Okay. And what does that look like, Rich, to change administrators?
It's called a takeover plan, and it's very common. And the ones we get are the ones that are messed up, and we have to fix them. But I have a client, Rich, this client's not happy with this administrative firm. Can you take over? Yeah. First thing I do is I look at the plan design. I say, we can enhance this. So I'm going to look at, can I enhance the plan design? Can we improve upon it? Otherwise, we will take it over, and we will redo the documents, and we'll basically that's the approach we take. So we'll look at the plan. Number one, can we enhance it? And then once they accept our terms, then we will redesign the plan or just redo the documents, and then we will do the administration going forward.
Great.
Very common, by the way. I got a lot of clients because of years and years of working in this business. I have a lot of connections, and I get a lot of referrals like that. Now, sometimes I really don't want them because, Rich, I haven't done a plan in 5 years. That's nice.
Yeah.
But we'll help out because we're specialists at that, and we have the right team. And again, our team, it's not just me. We have remote people throughout the country. We didn't touch upon that, but just so you know, we have people in Tennessee. We have people in a couple people here, and there's people in California. So we have a very good network of administrators, a half dozen throughout the country, and very qualified. Every one of if I brought the resumes in of all the administrators, they all have lots and lots of years of experience. The one that I like the best is Danielle. She lives in the city here in Vegas, and her and I have been working together in 2 different jobs. We worked at another company, and I brought her on board when I moved to this company. So we've been working together over 20 plus years, the two of us. She's a 401k plan administrator.
Okay. So with interest rates, yeah, thanks, Rich. With interest rates the way they are today, does that have any impact on these plan designs for a cash balance plan?
Well, you have to be careful. So when you're investing, I have some clients that are trying to reach the moon. You want to be more conservative in a cash balance plan because, I can see making a lot of money in the plan, but what happens if you lose a lot? This is a requirement. This is a defined benefit plan. You have to make those contributions to meet the liabilities. So you want to be a little more conservative in a cash balance plan. You can be way more aggressive in a profit sharing 401k plan.
Especially if you have employees, right?
Yes. So you really want to, and again, I will bring that up. And again, even if they had a really good year, that's going to have an impact on the contribution requirement, and that will be reflected in my funding letter in the next year. So we will look at this. Hey, you're overfunded. You got too big of a return. Matter of fact, that example I gave you with the $200,000-$300,000,
Yep.
that client is way overfunded. So I told them that we have to freeze contributions into the cash balance plan and just continue to do the formula. And you'll notice how I increased their benefit by $600,000. Okay, I gave $44,000. I increased their benefit, so now we can eventually now close that plan. That's a great example.
Yeah, thank you. Are there regulatory, legislative changes that
all the time
impact these that you want to mention?
Well, Secure Act brought a lot of stuff into play. There's going to be new requirements on minimum required distributions. It's looking like it's going to like 875. That's big. The one that I was hoping they changed that haven't is the loans. It's $50,000 max still, and that's been like that since I started this business. They've never changed that.
Go back. You said 875.
No, it's $50,000 is the maximum loan you can take, and that hasn't changed.
Sure.
There's changes in the deferrals in a 401k plan, where if you're now over 50 and you make more than $150,000, you can't put that into a 401k deferral. It has to go into Roth deferral. So we have to monitor that.
Sure.
That's going to
be
the
catch up, right?
Yeah, the catch up is going to be taxed.
Sure.
The IRS is making changes all the time. I mean, it's amazing. The limits keep on going up. That's a positive. There's a lot of stuff going on right now that we're still working through, and obviously trying to update documents because they have stuff going on. We haven't done amendments for them yet because the IRS hasn't come up with a proper language.
Yeah. I have noticed that over the past, say, 5 years or so, there's just been more complexity to these, right?
Yeah, there really has. And as a matter of fact, that's why that continuing education and just continue to take, which is what you and I should be doing with CPA firms, going out there and giving a talk and tell them what they can do and what they can't do. And they get CE credits and we help to educate.
So, Rich, if there's a business owner listening to this and they're asking themselves, hey, is this right for me? What's the first conversation that they should have, first questions that they should ask, and with whom?
Well, if it's you, they just say, listen, I got some forms to fill out. I'll get back to you in a couple of days. Let's look and see if we can do something for you. We want to get them to send us their information, company information.
Because we need the data. Yeah.
So basically, the first thing I would say, listen, I'd love to look at, I'll ask the person's age. I'll ask them if they have employees. And I'll ask them about income. But I'll say, listen, I'm going to send you some forms. Fill these out. And the more detailed that is, the more effective my design is going to be and the more protected you are. Because if I do a design and then later on you tell me, oh, by the way, Rich, I have another company. Oh, by the way, Rich, I have another plan. Yeah. No, we want that information filled out because that tells us, do you have other plans? Do you have other entities? Give me some information on your employees. Now I have enough information so that, hey, listen, I noticed you have a 401k plan. Please send me the plan document so when I design these plans properly, I incorporate that.
So what's the one thing you wish you knew business owners that you could help them understand?
The fact that they're missing out some great opportunities and stop worrying about the fact that they don't know enough about the topic. My experience is people want to know things about something, and sometimes you have to have trust in what we do because you're never going to learn all the facts. Like if you came to me right now and you said, Rich, I want to learn about DB plans, I would come back to you and say, Adam, you're in the wrong profession. If you want to learn about DB plans and become an administrator, you're an advisor. You want to know your stuff, not my stuff. You want to know enough to be knowledgeable, but not to a point where you need to know both. That's the wrong perspective. And I have people like that say, listen, you're in the wrong profession. I don't want to know much about investments. I know enough to help you out, and you know enough about plans to help me out. We don't need to know more than that. It's a waste of your time. It's a waste of my time. Do you agree with that?
Sure. It is very much a specialist
very much so.
role.
Very much so.
And with that said, Rich, thank you so much for being a specialist and for the collaboration, the relationship, and being available to talk and consult with the clients that we work with and in the future as well.
Oh, thanks for having me. I really enjoyed this. I want to do it again.
Thank you, Rich. Appreciate it.
Can I say one last thing?
Sure.
Critical thinking, the other national deficit.
All right. Well, thank you.
You can edit that.